Over the last year and a half, there's been a lot of confusion around the R&D tax credit and Section 174. I know because personally I was confused for months and months on end, but now we fully understand it. It's the way of the land right now. So we want to break down the differences between the two and if your business actually needs to do Section 174 or not. Lucy, next slide. Yeah, so I'll introduce the team and who we are, just 2 slides so you know who you're speaking with. And then Sean will get into the R&D tax credit and Section 174, closing thoughts as well. And then we'll also open it up to questions from the audience. So we'll be able to answer some live questions and some ones that some of our clients have sent us beforehand. So, interesting fact of the day, as of December 2024, the IRS has processed over 225 million individual income tax returns for the 23 tax year and issued more than 280 billion in refunds. Now, the tax filing season for 2024 begins in late January. That's when the IRS reopens, and the tax deadline for most filers will remain April 15th, 2025.
And the tax window is closed. You can't electronically file business returns until January.
Yep, the IRS is off for winter break and they'll be back in January. So our lawyer insists that you read this. We have to read this just to make sure that you know that the information in this webinar, it's only meant for guidance. This isn't professional, legal, or tax advice. In order to give you actual tax advice, we would need to have a one-on-one review your finances, everything like that. Also, this does not give personalized legal, tax, investment, or any other business advice in general. There are always exceptions. The exception could be you. Now, with punchline in the news, as the IRS prepares for the tax seasons, refunds average around 3,300, but new tax changes could change some things. Filing early actually could mean quicker returns, but double checking those deductions are going to be huge because AI is now helping the IRS spot mistakes faster. So get ready, make sure that your books are tight, make sure that your return is being filed in a compliant way as it should be. And let's get ready for another one. I can't even believe we're going to have another tax season coming up. So enjoy Christmas first, New Year's, Hanukkah, all of that. So a little bit about who we are. My name's Ashton. I'm in charge of client experience, making sure that our clients have a good experience while working with us. Miguel is our managing partner and founder who's been with the company since its inception, since it's his company. He's an R&D tax credit specialist, has really built the practice around being an advisory first firm. And then Sean, who's been consulting with us for a little while now, is officially running our R&D tax credit practice. He left Deloitte to come join us at some point this year. So if you do an R&D tax credit engagement with us, you'll be seeing a lot of Sean. I'll be in the background helping with some project management, and Miguel will be reviewing, approving, as well, being involved in our tax credit engagements. So, we are Miguel's ex-PwC, Sean is Deloitte. So, we're tax experts. We're looking to bring that same type of Big Four experience to small and mid-size and some large companies as well. We really focus on digital marketing, e-commerce, and technology companies. So whether you're IoT, big data, SaaS, AI now, that's really where we specialize and focus a lot of our efforts, especially when it comes to the R&D tax credit. We know these industries inside and out. We all come from tech backgrounds as well. On our staff, we have IRS enrolled agents. We have CPAs on staff as well. But at the core of it, the R&D tax credit is a core specialty of ours. We also have a real estate practice, a small real estate practice, where we do specialize on cost segregation. But for the purposes of today's webinar, we want to get into the R&D tax credit and Section 174, so you know exactly, do you need to pay attention to 174 or not?
Awesome. Yeah. Thanks, Ashton. So here's the thing. If there's one thing you all remember from this webinar, this presentation, right, it's right here. The R&D tax credit and Section 174 are completely separate, right? They are two separate things. We'll get into the differences and we'll get into some similarities, but they are two different tax impacts, tax regulations, and tax codes. So just keep that in mind as we go through this. So let's cover the R&D tax credit really quickly and really briefly. So the R&D tax credit is a general business credit, right? It reduces your tax liability. It's available to companies that incur R&D costs in the US. It's available at the federal level and the state level in most states. And the credit can be claimed on all open tax years, retroactive 3 years, and can be carried forward on your returns for 20 years. And then lastly, for our small businesses, startups that are in losses, you can take the R&D tax credit to offset payroll tax on your tax returns for up to $500,000. So it benefits those companies that have large tax liabilities as well as startups that are in losses. Now, what is Section 174? Again, totally separate from the R&D tax credit, right? Section 174 was passed in 2017 under TCJA, or the Tax Cuts and Jobs Act. It is the mandatory capitalization and amortization of research expenditures for all companies that incur such costs. So what does that mean? That means that if you have R&D costs in the US, you can no longer deduct them in the year that they're incurred. You now have to capitalize and amortize them over 5 years in the US or 15 years for foreign R&D activity. So, previously, if you had expenses related to R&D, you were used to incurring those expenses in the current year and then deducting them. Well, now you have to capitalize and amortize them, spread them over 5 years. And again, you can no longer deduct those in the year that they are incurred. And then, how does this impact your business moving forward now? Right, the current impact and the largest impact is there are less deductions in the tax year available, leading to a potentially higher tax liability, right? If you can't deduct all those expenses in the year they're incurred and you have to spread them out, you no longer are deducting as much, and it could force you into a profitable position or even more of a profitable position where you're paying tax and have a liability there. And also for NOLs and carry forward. So those clients that are in losses that are carrying credits forward, more of the net loss can be carried forward. The tax credit may be used to reduce your liability, assuming you have sufficient carry forwards or unused credits. This also affects other tax areas, estimated tax payments, state and local taxes, as well as Section 163J. So there's a lot of impacts for Section 174. The overall general bottom line is it may increase your tax liability just because of the minimal amount of deductions in the current year. So here are 2 examples, right? On the left, you'll see an example before Section 174 was enacted. On the right, you'll see something that shows post 174. So let's cover before 174 first. The scenario here, you see this example, this taxpayer has $1 million in R&D costs, right? And you see that Section 174 pre-rule change allowed the taxpayer to have 4 options. Typically, I won't go through all these options, but typically your taxpayer is going to choose option 1, right? Deducting the whole $1 million in the current year to reduce tax liability and maximize their deductions and expenses that they're writing off essentially. And then they have 3 other options they can take, right? Now that Section 174 is in place, let's see what happens to this same situation where we have $1 million in R&D costs. Now you have to capitalize and amortize $100,000 in 2022 or whatever year we're talking about after 174, using what's called a half-year convention for this new rule change. You also have 2 other options where you can capitalize and amortize $100K in 22 under Section 59E, and then capitalize the entire amount with no amortization. I'm not sure why, there would be a specific fact pattern why you'd want to do that, but typically we see option 1 here as the most accurate and the most common. So the bottom line here is the taxpayer can no longer deduct the $1 million under the new rules in the year the expenditure is incurred, like you could pre-2021. So can you ignore Section 174? Like we previously mentioned, right? Section 174 is mandatory. All businesses that have eligible costs, R&D costs, must calculate a Section 174 amount for their tax return filing. There are no exceptions until the rule changes and when it changes. For tax year 24, Section 174 is still in play, right? So there have been no updates on any rule changes. There may be hopes that this regulation is repealed at a later date with the new presidency, but again, nothing has changed for tax year 2024. Capitalization and amortization requirements. So what are the requirements under Section 174? What should you be looking out for? And what costs are eligible? So all R&D tax credit costs that we include for the R&D tax credit would be eligible for Section 174. So that'd be your wages, any supply expenses, any cloud and hosting expenses, and contractor spend. Now, Section 174 includes what we call incidental and indirect costs as well, right? So above and beyond everything you see for Section 41, we're also including overhead, payroll taxes, patent costs, rent and facility costs, things like that have to be included under Section 174. And then the bottom part of this slide just kind of shows you the general rule of capitalization and amortization over 5 years, and then what the first year, sort of the half-year convention calculation is.
Yeah, so I just want to highlight, Ishan, something you've said before is that the amount that gets amortized is going to be bigger than just the R&D credit base. So also for the R&D tax credit base, the QREs, we use box 1 of the W-2. That doesn't include a lot of the benefits that employees are paid. For purposes of capitalizing 174 costs, you're taking the fully loaded baked potato, if you will, and adding some toppings on with the indirect costs. So, Sean, I think it'd be helpful to, you probably have it, but just like, does that mean if my developers are sitting in part of the office, I'm now allocating, rent? I know you're getting to that, but I just wanted to call that out because I kind of saw it as this is what it means.
Yeah, great point. Yeah, so for those sort of incidental and indirect costs, right, you might ask, well, why do I have to include my whole rent or my whole facility costs if I have other departments and other teams in the office? There's an allocation sort of methodology that's used where you just allocate the portion of those costs that your R&D personnel are using. So for example, if you have 5 R&D personnel in your office and 5 other team members that don't do any R&D activity, you would allocate 50% of those overhead costs, right? So 50% of your rent, 50% of your utilities, so on and so forth. So there are different ways and methodologies that you can use to allocate those, and that's one of the sort of service offerings that we have now, and sort of the methodologies that one of the methodologies and scenarios we calculate. You can go to the next slide, Lucy. Thanks. Awesome. So a question that we get asked quite often, and that we're all wondering as well on the tax side, looking inside, what's the future hold for Section 174? As I mentioned earlier, there is a possibility that Section 174 could be repealed with the new presidency. Nothing has happened yet for tax year 2024. The rumor mill, or whatever you want to call it, says there may be a lame duck session. So just a convention, sort of everyone gathering in between these presidencies to reconsider the retroactive legislation restoring regular expensing and deduction under Section 174. So pre-Section 174 rule change, hopefully those policies will come back into play. But again, that's just in the rumor mill for now.
Yeah, and just to give some context, I think the history is like interesting, is that the law of the land was amortization. We forget, because I wasn't doing taxes in the 80s, but prior to or even the early 2000s, prior to the 2000s, it was a temporary provision to get full deduction when you develop IP. So just like there's depreciation rules, if you place a car in service, you've got to depreciate it over its life. What these rules essentially mean from an economic perspective is that we see the development of IP as having a life of longer than 1 year. 5 years. Now, why is it 5 years US, 15 years international? Can't exactly give you the economics of that. That might just be making domestic development more favorable. But essentially what the Tax Cuts and Jobs Act did is it basically said, the way we're going to pay for all these tax savings that you guys are going to get, for those of you that, were with us in 2018, it was hunting season. You know, we had all these tax credits, we had bonus depreciation, but the way that Congress wrote in the rules, they said, hey, we're going to pay for this by expiring things after a 5-year period. Everyone thought that they were bluffing, you know, because, you know, when has Congress ever been responsible? And in truth, they didn't let it expire because they thought it'd be responsible. They did it because, well, I think I'm leading into opinion here. Okay, I'm leaning into opinion here. They let it expire, I think, out of just complete negligence and incompetence. Because why would you impact small tech companies that aren't cash flow rich in a time of inflation and a time with uncertainty around employment? Why would you impact them negatively like this and give these, you know, from a cash perspective, they're barely breaking even, right? They're trying to extend the run rate. And now because you're spreading out their costs over 5 years, now they're in a profit position, have to make a profit payment. So a lot of what we're talking about here, like kind of the unsaid, you know, we are presenting on what it is, but a lot of the unsaid is that tech companies are essentially saying, like, you know what, I don't know if I can survive if I get this rule correct. And that would be a correct position. I think some folks in Congress get that, but there hasn't been any level of collaboration up until you know, the election. So in January, a bill was introduced to the House that includes various provisions, including the repeal of Section 174 capitalization treatment. It was voted on and passed, sent to the Senate, re-voted on. I think we did a webinar the week of, in the first week of August, re-voted on block in the Senate. So when we say there might be a lame duck session, it's not just, you know, surmising. It's this, you know, WT heck of, hey, you know, you guys were supposed to fix this. And truth be told, I was just at a tax conference, like really technical tax conference, like the kind that that we don't tell our clients about because it's that technical and boring. And you know, I'd never been in a group with this level of consensus where like we all thought that Congress was going to figure this out. So thank you for my tirade. Thank you for coming to what ended up being my TED Talk. Back to you, you Sean.
Sounds good. No, that alludes into and kind of leads into the next slide. So if you go to the next slide, right, one of the first things we mentioned here, right, R&D tax credit, Section 174, completely separate. A lot of times with a lot of times we get the question, well, I don't want to do the R&D tax credit because I don't want to deal with Section 174. And here's the response to that. So I want to spend a little bit of time here. Section 174 is mandatory, right? You have to do it whether you take the credit or not. Likely, and as Miguel mentioned, it will increase your tax liability for you know, any size business and push you probably into a tax paying position, right? The R&D tax credit, on the other hand, like we said, is a general business credit. So, you know, it's made to reduce your tax liability or help offset payroll tax. So because you must do Section 174, why not also take advantage of the R&D tax credit to help offset or even eliminate some of that tax burden, right? You have a negative impact coming from 174, and the way you can help offset that as much as possible is the R&D tax credit. It's obviously not going to erase 174, it doesn't get rid of it, right? But these are two things that kind of clash, and you know, you can take advantage of you know, eliminating or reducing the tax burden by taking a look at these two things. So again, one of the questions, like I said, we get is I don't want to do the R&D tax credit because I don't want to do Section 174. Well, the news is you have to do Section 174. So we encourage you to also do the R&D tax credit, and you know, let us help you reduce that tax liability. We could go to the next. Thank you. Okay, so again, as I mentioned before, what are we doing? What is Tax Act doing around the R&D tax credit in Section 174? So I'll go through the R&D tax credit fairly quickly, but we go through a project qualification and documentation sort of phase, time allocation surveys and qualified activity evaluations, surveys and calculation reviews, and then finally your tax forms and audit ready deliverables. So that's kind of our workflow, sort of the engagement process of the R&D tax credit. A lot of it is focused and centered on documentation and supporting documentation that's crucial for the IRS under audits, and just for record keeping as well. And now what are we doing around Section 174? So obviously Section 174 education. So hosting webinars like this, producing content and getting the news out to clients on what Section 174 is, why you have to do it, should you do it, and so on and so forth. But the way we get into sort of the data review is through trial balance and P&L review. So taking a fine-tooth comb and looking through these data points and determining what costs are Section 174, what can we pull out to help benefit you? And then, like I said, determine potential areas of exclusion for Section 174, reducing your 174 amount as much as possible, and then calculating the 174 amount and preparing your summary schedules for tax return filing. So doing both these things side by side allows for built-in efficiencies and the ability for us to leverage data cross-functionally and optimize results. So there's a lot of data that we collect during the R&D tax credit process that can be used for Section 174 for us to model different scenarios and try to get you, a Section 174 number that's beneficial as much as possible. Awesome. And so here is a QR code for Q&A session. So if you scan that, I think it may lead to a screen where you can input a question, and then we will be able to see those questions on our side and then go ahead and answer them.
Yeah, I have a question for you. So I know a lot of clients, they don't, like you mentioned, they don't want to do the R&D tax credit because they think that, they have to do 174 as a result of doing the credit, which is not the case. Now, if people don't claim the credit, the R&D tax credit, they still have to do this, correct? 174.
That's exactly right. Yeah, you have to do Section 174 no matter if you claim the credit or if you don't. If your company makes $1 or several billion dollars, and you have R&D costs, you have to claim Section 174.
Okay, and can you just explain a little bit further what the difference is between R&D expenditures and costs versus how we use those for the credit?
Sure. So what we calculate for the credit, I'll start off with the R&D tax credit, right? Is we calculate qualified expenses that go into your credit calculation. What those are wages, supplies, contract research, which is contractor spend, and then cloud or hosting expenses. That's all used to get your R&D tax credit. What Section 174 includes is all of those costs that I just mentioned, as well as overhead, rent, utility, patent costs, payroll taxes, what we call incidental indirect costs. And then the wages, like Miguel mentioned earlier, are calculated slightly different. So Section 174 casts a wider net than Section 41 R&D tax credit.
Right.
Yeah, and again, that makes sense from a governmental standpoint, right? Section 41 is beneficial to businesses, less beneficial to the IRS. They give you a smaller pool of costs. 174, better for the government, better for tax collection. They cast a wider net and they want more costs included in that net. And that makes sense from their perspective.
And I think it's important to think about like if a question did come in, like what's going to happen in kind of the audit world. I think it's important to think about how 174 is going to be just easy, like low-hanging fruit for adjustments over the next 4 or 5 years. Many of us in the tax space know that audits happen 4 years in arrears, right? So 2022 is really not going to be looked at until it's almost 2025 already, but till 2026. So about 18 months out, I expect we're going to start seeing notices for taxpayers who previously claimed the R&D tax credit and all of a sudden said, we're taking full deduction on everything and we stopped taking the tax credit. So I think some other, firms, advisors I've talked to, they've said that was kind of the trend in the industry, right? Or the pushback from clients that we're talking about. They're saying, okay, well, don't claim the credit because we're not going to amortize. It just makes no sense to have and we had these discussions with our clients too, but it makes no sense to claim the R&D tax credit for 3-5 years. We've documented the projects and development work of them. And then all of a sudden the paper trail disappears. Obviously, as tax advisors, we can't do that. There's rules, Circular 230. Um, there's professional consequences for knowingly filing an incorrect tax return. But I think if you're looking at it from the IRS perspective, looking, if you think about a transcript, with kind of year comparison, just looking at the ones that claimed the credit, and then dropped off in 22, it's just going to be an easy way to say, hey, we're just going to assume that you had the same amount of development spend from the prior year. We're not going to give you the tax credit, right? Why would the IRS ever do that? We're not going to do that work, but we are going to add back 80%, sorry, 90% of the development cost from the prior year to create a tax liability.
That'll be fun. I'm seeing when this will get reversed as a question, or if will it ever get reversed back to how it used to be.
Yeah, I mean, our hope is yes. There is momentum behind that. It will get reversed. When it's is the magic question. We've been in hopes that this would get reversed for the last year and a half, 2 years. But there is even more momentum now that this will get reversed. I think it's just now an administrative sort of process that once the new president is in office, they will start to take a look at these issues, and then slowly it'll move up the chain. But our hope is that this, or at least my hope is that this rule is not in effect for tax year 2025. I think that's everyone's ideal scenario. But again, I feel like just looking at what people are saying and talking to people, there's momentum behind this hopefully being repealed soon.
Okay. So let's say you have amortized in 23 and then in 24 it gets reversed in 25. Does that mean you can go back and file amendments and get higher deductions in those years?
Yeah, that's a great question. There is no answer to that yet. It'll probably come with a complicated set of rules. My guess is that they come out with a way to go back and recalculate and re-amend that is so complicated that clients will forego doing so. That's typically how these things work. So, there may be a possibility that that's part of the rule change, if and when it does happen. But I think it's going to be a fairly complicated and, burdensome process to go back and recalculate those things and amend.
Yeah, I don't know that I think the current legislation right now has a retroactive repeal. Um, haven't heard anything yet, just because this is kind of a period where nothing gets done. There's basically just pardons getting done that are making headlines. Um, if the Republicans have a more aggressive agenda for tax reform, I think unfortunately this is probably going to be delayed. What I think I'm hopeful for is that there'll be some kind of guidance that now that there is kind of this one party rule, at least what they can do is say, hey, these are the things that we're unified on. That way we can make tax payments. So getting back bonus depreciation and deduction treatment are two of those things. So what we're hoping, and it's really hard being in the tax community not knowing, because you got to prepare estimates. I mean, uh, for clients on here, you have to make your payments by January 15th in order to avoid underpayment penalties. 415 is to avoid failure to pay penalties, but with the underestimated penalties kick in for not paying by January 15th. So we need to know by January 15th what the law of the land is for 24. My hope is that there is some guidance saying, hey, for tax year 2024, we are going to bring back deduction treatment. We're going to get this through the House. So a message like that would be very assuring to the business community that is in tech. These rules don't just impact Google, so these are small businesses. Some of these are self-funded. Some of these are, seed family rounds, borrowing from uncles and aunts and friends of the family. So these are small businesses that really need this. So, but what I just one kind of public service announcement, and I hope we can repost this across the board. But I just messaged a Notion link to a template that you can send to your senator. So this is something that was going around on Reddit within the community. We're publicly in support of it, but essentially copy paste template you can now just email to your Senate office. So it is stuck at the Senate. We had bipartisan support. No reason it doesn't go through. But yeah, big question of whether it'll just be for 2024. Is there potential that it'll actually just be 2025 and going forward? I'm certain that's potential. I don't know why it would be, but certainly not sure that we will get changes to 23 or 22.
Yeah, and I think one thing that you mentioned, Miguel, is it doesn't just hurt small companies, it hurts big companies. And the effect, holds the same weight for those types of companies. I've seen a $20,000 Section 174 and I've seen a $1 billion Section 174. And both those companies were equally as, let's call it, upset, wanted the rule change just as much as the other. So the impact and the weight of this is pretty similar between all sizes of companies.
That's right.
Any other questions you see, Ashton?
That was it for what I see. Yeah.
Okay.
I don't think so.
Yeah, I mean, another question is, how do these, that we get from clients that are thinking about doing 174 and R&D right at the same time, how do these engagements run? What are sort of similarities between the two? We covered a little bit of this, but the thing about these engagements for R&D and 174, I know we said they're completely separate, but we can run them side by side, and build efficiencies, help reduce client touch points, client meetings, right? And make that process extremely efficient, and collect data for everything all at once so that we can go through that analysis sort of at the same time. Both numbers, the R&D tax credit, Section 174, are due at the time of filing. So their timelines are, exactly the same, which sort of helps the projects run side by side. So, these two things run fairly smoothly on our end when we do them side by side.
I am seeing one more question, and I'm assuming I know how these guys have filed. They did not amortize, do Section 174. They took 100% of the deduction. Now, if this ends up getting reversed, what does that mean for them?
Yeah, I mean that. So if this gets reversed and there's 100% deduction on the return for any prior years, there's going to be sort of if there is a possibility that return gets looked at, for lack of better words, caught, there may be some sort of penalty and correction or amendment that needs to be done to fix that for the rule in that specific tax year. And there's obviously going to be some sort of calculation that has to be done for that 174 amount to correct that amount for that tax year.
Gotcha.
Yeah, I mean, we live in a world of managed risk, essentially large companies do this all the time. They just call it a tax reserve. So they say, hey, I'm taking a position that is in a tax gray area. And I'm ready to disclose it, and I'm going to put aside a portion of that tax liability. Just know that those tax reserves can be big. So if we're talking about $500,000, if you're a tech company, if you develop, that's a huge amount because presumably most of your payroll would be amortized. And I mean that's why this is such a big deal. That's why so many people are fired up about this. But that essentially means if you have a $500,000 reduction and you broke at zero, and you're saying I'm paying zero in taxes, you file your tax return, The reserve essentially would be changing that 500,000 to 50,000 because you're essentially amortizing 90% of it because it's mid-year convention, kind of we were talking about earlier. So you got 450,000 and it gets added back to income. And 21% tax rate on 450,000 is going to be like 90 grand. So this is a lot of money. 90 grand to put away to say, hey, I might pay the taxes is a huge amount. Huge amount. So we've been advising our clients to do the 174 analysis so that we are very thoughtful about what we're adding back. Because when you knowingly file an incorrect tax position, again, it's one thing if if you do a little bit of dev, you've got kind of a side product, but as a tech company, if you've got that much of a delta, you're talking about very serious taxes and penalties. Not to scare anybody, but it starts getting into the knowingly filed an incorrect return above 50,000. The penalties can be 25% of the tax bill. So, we're talking big numbers. So what we want to do with the 174 analysis is take a thoughtful approach to take some of it on the chin. It shows that we filed correctly. The taxpayer went through the exercise of evaluating it, and we're able to go, if there is an audit event, we're able to go to the IRS and say there was a process to determine this amount. And here's the other thing that we don't talk about, but that deduction carries forward. So yes, it really hurts in year one. But what we started to see with our clients with the 174 is that they've now got a stack of prior year deductions of amortization that they didn't anticipate in their tax bill. So for the clients that did say, you know what, we're doing 174 right away, in year two, they actually got a nice little surprise in that when they did 174 on their current year, maybe they saw 20,000 in income. Well, then they brought forward the 20% of last year's, which reduced their taxable income. So, yeah, year one, it's really hard to take it on the chin. It's the law of the land, don't shoot the messenger, but also, don't don't hate your tax person for not wanting to, get you in trouble and not wanting to file a knowingly incorrect tax position. It's the effects of Congress are what we reflect on the tax return. That's just the nature of the game.
Yeah, and I'll piggyback off just reserves. I mean, the most common that I've seen is at least like 20 to 25% reserves because, like you mentioned, you're taking 21% of whatever the amount in question is. So, typically a 20 to 25% reserve is the most common clients take.
Right. Well, I'm not seeing any other questions, so I think that concludes our Q&A session.
Awesome. Well, I just want to thank everybody for taking a listen, either live or when you get this webinar and in the recorded version. If you have any questions, my email is there. And then you can visit the website at mytaxact.com for additional information or to get started.
Okay. Thank you, everyone.
Thanks, Ishan. Thanks, Ashton.
Yeah,
See you
thanks
guys.
all for listening.